Good evening. We're going to go ahead and get started now. This is the webinar, Is Your IRA Working as Hard as You Are? And I'm Dean Jenkins, the founder of followmetrades.com, and I'll be the presenter tonight. Thank you very much for coming. I'm really excited about sharing this material. This is the first time I've presented it. I did quite a bit of research and put this together. I've got a handful of other venues where I'm going to present it, but you're hearing it for the first time tonight, so you're a select group. So here's what I'm going to cover tonight. I'll cover these 5 topics. First, I'm going to cover 4 good reasons why trading in a tax-deferred account can make sense, and it may make sense. What you can and cannot do in a tax-deferred account, how you can profit from bearish trades in a tax-deferred account, even though the IRS doesn't allow you to actually short trades in tax-deferred accounts. How you could even trade future contracts in a tax-deferred account. And I was surprised by that until I learned how you could do that. And then the last, how to determine the appropriate trading account size. Just some ideas on that. First, of course, we got to cover the disclaimer. And the disclaimer is, trading in the financial markets is speculative. It involves some risk of loss. And I'm doing my best to provide reliable information, but it's intended for information and education only, and it's not investment advice. I'm not an investment advisor or a tax advisor or any of that. So again, my best attempt to make it accurate, I believe it is, but you need to do your own research and make your own decisions about your financial position, or consult a tax advisor or a financial advisor. So first thing we said we'd cover is 4 good reasons why trading in a tax-deferred account can make sense. And I'm going to use the term IRA just for brevity. But that, instead of saying tax-deferred account every time, I'll use the term IRA. This applies to other tax-deferred accounts like a SEP, a 401k, any tax-deferred account. And there's 4 good reasons, here they are, why trading in a tax-deferred account or an IRA can make sense. Potential tax savings. You can get higher growth year over year, primarily due to those tax savings. You may have access to more trading capital if you do include your IRA in your trading, and you certainly get simpler tax reporting. So let's look at these one by one. Potential tax savings. When I talk to other investors and traders, I'm really surprised how many people have their long-term conservative investments in their IRA, their tax-deferred account, and they do their more active trading and investing in a non-deferred account. Actually doing just the opposite of that can and may result in substantial tax savings. Again, some people find that surprising. I think it's important to view your entire investable net worth as a whole, not to say, well, this is retirement money and this is investment money outside of that and this is trading money. I think it's important to look at it as a whole investable net worth. I don't think that includes your home equity or other assets like that. It's the total amount of money, financial resources that you have available to invest in things like stocks, bonds, mutual funds, options, futures, contracts, forex, whatever it is you invest in or trade with. And even if you decide that trading actively in your IRA does, that makes sense for you, that does not change the need for prudent asset allocation. That is still important. I'm going to cover that at the end, some ideas about how much money you should have in your trading account, some ideas for that. So what are the potential tax savings in an IRA? This is kind of the meat of the presentation right here in these couple of next slides. So we're going to do an example. There's some minor potential savings that if you have gains in your IRA, that later when you withdraw them, you'll be in a lower tax bracket. So most financial planners make that assumption when they put together models that in retirement, you're going to be in a lower tax bracket, so gains you make now, you'll be paying less tax on later. So that's a minor that's a minor savings, and that may end up being true or not true. It depends on future tax rates, your own circumstance. Here's a potential saving. If you are successful in trading in a non-deferred account, that could raise your adjusted gross income and move you to a higher marginal tax bracket. And gains in the IRA won't do that. They only count as income when you take a distribution, when you withdraw money from your IRA.
So the major savings, here it comes, is um, you got to pay taxes on non-deferred gains for the current tax year, which effectively lowers your real net gain by the amount of tax that you paid. Right? You have to take that money out of the gains, and then you don't have it to invest and have compound growth from that. So in a deferred account, you're only taxed on the net gain when you take those distributions, so you can continue to use that money and invest it and trade it and have compound growth on it. So let's cover this in an example here. So an example, married joint filer, so making between 74.9 and 151.2, their taxable income from the 2015 tax tables, they're in the 25% tax bracket. So let's use these numbers for a 2015 trade results. These are the actual my actual results. These are the picks that I'm publishing to my subscribers. So 54 trades so far this year. Net profit so far this year of $25,847. If you base that on a $100,000 account, that's 25.85%. I've done better in previous years. It's been kind of a tough year as the market has topped out. I'm pretty happy with those results for the market we're in. So in a non-deferred account, say it's a $100,000 account, we got a starting balance of $100,000. We've got a gross gain of $56,896, gross loss $31,049, with a net gain of $25,847. Now I got to pay 25% tax on that, so I pay $6,462 in tax, which leaves me a real net gain of $19,385. That's what I have left that I get to keep and that I can continue trading with and get compound growth on. So the ending balance after I pay taxes is $119,385. In an IRA account, starting balance of $100,000, same gains, same gross gain, same gross loss, same net gain. I get to keep it all. Now I do have to pay tax on that at some point when I withdraw it, unless this is a Roth IRA, which you put after-tax money into a Roth IRA, and at that point you could withdraw this and pay no tax on it. But let's base this on a traditional IRA. So if I leave the money in there, and then I got the full amount of my gain plus my starting principal that I can use in the next year to trade or invest, and I get to compound gains on a bigger account. That's kind of a big deal. It's a big difference. There's 25% more real gain in my IRA, again from the exact same trading results as opposed to doing it in a non-deferred account. The next topic here is higher year-over-year growth, and that's primarily due to those tax savings. If we compare two accounts here over a 5-year period, so here's a non-deferred account. We got the exact same starting balance, $100,000 in each. Here's the IRA account again, a traditional IRA, and we take it out 5 years. We'll just use that flat yearly gain percent that I've got year to date. You got to plug some number in. Today's results don't guarantee the future, but I've been doing it for years and getting better results than that. So those are the numbers I'm using. You can see because of the tax that I've got to withdraw and go pay the government. My real net gain is less. The amount that I have left to trade with is now less. And over time, that starts to add up. In my IRA account, if I make the assumption that I leave the money in there, I don't take it out, you can see that this account grows larger and quicker than the non-deferred account because I'm not having to take money out and pay taxes. I only have to pay taxes when I do take money out of the account. And you can see after 5 years, the difference is, in my non-deferred account, I got 242,523, and in my IRA, I've got 315,656. That's a $73,133 difference, right? And over in my non-deferred account, I've paid over 5 years $47,508 in taxes. Now, it's true, I do have to pay taxes at some point on the IRA account when I take the distribution, But because of the compound growth on the money that I did not have to go pay in taxes, um, I've got a bigger amount to work with now. And when I do take it out, right, I got to pay taxes on it, but I'll still be left with more money. And that's really the name of the game, is keeping as much of my money that I worked really hard to gain. So I think that's a big deal to be aware of. Again, don't know your situation, but I think it's useful to have this information to be aware of it as you make decisions about what account to trade in, how to manage your accounts.
The third reason it may make sense is access to capital. Some stats here. Now, there's a lot of money in tax-deferred accounts. According to the ebri.org group, the average IRA balance is $105,000, and the average 401k is $91,300. People who've been contributing to their IRA or their 401k for 10 years or more had an average of $250,000. That's a lot of money. So this is not a suggestion to take inappropriate risk with your retirement funds. But I think it is useful to talk about viewing our financial assets as a whole and to understand the tax implications of gains in deferred versus non-deferred accounts. I think that's helpful to know. And the last reason, it doesn't really save you any money, but it sure saves you aggravation when it comes time to do your taxes in non-deferred accounts. On Form 8949, you have to list every single transaction. In my example, 50 plus trades this year. That's a lot of data that, I certainly have it and I log it. I keep a detailed trade journal, but to go enter it on the tax form, most people end up buying third-party plugins to QuickBooks or Quick, TurboTax or something to export their trading platform data. It's a pain. If you're doing it in a deferred account, there's really one box to fill, and that's how much money did you take out of the account? What was your distribution? That's a lot easier accounting to do for the government. So those are 4 reasons. So I said I'd cover 4 good reasons why trading in a tax-deferred account can make sense. Now I want to cover what you can and cannot do in tax-deferred accounts. This is important to know as well. So what can you do in an IRA? Using that as an abbreviation. You can buy and sell stocks, ETFs, options, bond, mutual funds, and many other financial instruments, just like you can in a non-deferred brokerage account. So you can do an awful lot. Yeah, I said you can buy and even sell options in your IRA. That's absolutely allowed. We'll get into some restrictions here in a minute, but you can buy and even sell options in your IRA. You can buy and sell as often as you like. The IRS doesn't have any limit on the volume of activity or the number, the frequency of trades in your IRA. So some individual brokerage houses or custodians may have their limits. If your money is in a 401k or some other employer thing or state or government fund thing, they may have restrictions and not allow you. They may only let you invest in mutual funds or some limited universe of instruments. But the IRS is not imposing any limits. You can trade as often as you like. You can even buy leveraged instruments, 2x, 3x ETFs, some of which are designed to move in the opposite direction of the market, and that can be really helpful. And you can participate in commodity markets in your IRA through ETFs. You can trade stuff like oil, gold, coffee, all that stuff through ETFs, and even futures, which I'm going to talk about in a little bit. You can actually trade futures in an IRA. You can basically you buy, sell anything in your IRA that you could in your regular brokerage account, as long as there's no margin, no loan involved. And that really gets into the restrictions here now. What can you not do in your IRA? So you can't do anything that would, you can't do anything on margin that the IRS would consider a loan or using borrowed money. So loans cannot be taken out. Any loan cannot be taken out using your IRA as collateral. Not allowed, against the rules. So a lot of transactions in a normal brokerage account, when you sell a stock short or you buy on margin, right? Those are considered loans and they're not allowed in tax-deferred account. You can't do what's called free riding. And that, here's a description. There's a lot of text there. Got it from Zacks.com. Free riding is basically, it takes 3 days when you sell a stock for it to settle and the money from that sale to come back into your account. And you can't use that money that's not settled to buy another stock and to sell it before the thing is settling. That's called free riding, that you're basically buying and selling stocks with money that is not in your account yet. I've been trading stocks and options in my IRA for years now, and I've never run into a case where this limited me in any way. But it's important to be aware of. No free riding and no pattern day trading. So I said, there's no limit on the frequency, but there's such thing as pattern day trading. And so there's a specific definition for what pattern day trading is, and that's not allowed in an IRA. So those are things you cannot do. The next, how can you profit from bearish trades then? If you can't sell short, how can you profit from bearish trades in a tax-deferred account? Well, you can. You can. I said you can buy and sell options, right? You can certainly buy put options, right? Or other, if you're into more complex, all the birds, right? The butterflies, the condors, the iron condors, all that stuff. You can do that. Or if you have a bearish outlook on a stock or an ETF, you can buy put options. Absolutely allowed. And you can buy and then sell that contract without ever actually holding the stock. And you can actually exercise that option as well. So you can certainly buy put options, again, if you have a bearish outlook on a stock or ETF. There's lots of ETFs and mutual funds that are designed to go up when the market goes down. So you can buy those. And you can buy stocks or ETFs that you think will go up when the market goes down. So some are designed to do that, but then some, like gold, right? GLD is the gold ETF, right? So it's not designed to go up when the market goes down, but historically it has. Historically, there has been an inverse relationship between the stock market and gold. So you can simply, if your outlook is bearish on the market, you can buy the gold ETF, and with an expectation that it was going up. So that's a way to trade a bearish market in an IRA. And the topic here is what can you do in a bearish market? If you're not comfortable with more complex ETFs and 2x, 3x, and inverse, you don't have to sit there in your IRA. If you have a bearish outlook on the broad market, you do not have to sit there and watch your account shrink. You simply can sell your position to go to cash in a money fund and earn nearly zero interest. But I'd actually rather earn zero than to lose money if I had a bearish outlook on the market and I didn't want to do anything else. And if you're in an IRA and you sell these positions just to go to cash, there's no immediate tax implication for that. You're only taxed when you take the distribution out of the account. Different analysis in a non-deferred account, because part of your calculus has to be, if I'm going to sell this, what's my gain, what's that going to do to my taxes, right? Blah blah blah. A little more complicated. In a deferred account, you don't have to worry about that. Right? You only get taxed at distribution. How you can trade futures contracts in a deferred account. Again, this surprised me when I found out that you could. So you can trade futures contracts in an IRA, and I put the words there, I said sort of. So futures contracts are margin instruments, right? You buy them a margin, and you cannot trade them directly in an IRA account. And this is really a paperwork game that the IRS allows. You can open what is called a self-directed IRA. Here's a definition from Wikipedia. So self-directed IRAs were set up primarily initially for people who wanted to buy real estate, write private mortgages, get involved in private stock offerings, PPOs, stuff like that. Alternative investments. So self-directed IRA, there are custodians who run those and allow you to trade things that traditional brokerage houses want no part of. So you can open a self-directed IRA, and then what you do is you invest your self-directed IRA into a futures account with a brokerage firm. There are a limited number of custodians that do offer self-directed IRA. Your brokerage can tell you which ones they work with. And for example, TradeStation on their website, they list 3 companies that they work with. So they know all about this and they will help you. If you're interested in trading some of your IRA money in futures, for example, TradeStation, they'll help you do that. They have 3 companies, Equity Trust, Millennium Trust, and Midland IRA, that they work with. You go open a self-directed IRA with, say, Midland, and then you can take the money that's under this self-directed IRA umbrella with a custodian, and then you can transfer that into a standard futures contract account with TradeStation and trade away. That's allowed. These custodians have annual fees, typically a couple $100 a year. It's not too bad. It depends on your account size whether that makes a difference or not. But that's a way you actually can trade futures contracts in an IRA. And that's not a recommendation that you do that, simply educating that it is possible if you would choose to do that. So the final topic that I wanted to cover tonight is how to determine the appropriate trading account size. How much money should be in your trading account. Now, this is a very individual analysis, right? But here's some ideas. Some ideas to help come up with how much you should actively trade with. And again, I want to reiterate this point. I think it's really important to view your entire investable net worth as a whole, to not segregate it into, this is retirement money, this is my brokerage account money, this is my savings. Anything that you have that you could invest in stocks, bonds, mutual funds, options, futures, forex, anything, I view that as a whole and make decisions on the whole, not so much on parts. You got to determine your own risk tolerance. Different people are different. You have a different horizon for when you would need that money, and just a different individual risk tolerance for how much you are willing to lose on your trading journey. What amount of drawdown would make you stop. There's several free calculators online that can help with this analysis. I've looked at the ones from Vanguard, CNN Money, Yahoo Finance. They got some really nice tools. You can just Google retirement calculator or asset allocation calculator, and you can see some more examples. There's a lot of them available on the net. I'm going to give you an example here. So this is using the CNN Money calculator. So you go to their webpage, and they got a questionnaire you fill out. It's free, and they don't even ask for any personal information. They just let you play with their calculator. So they ask you some questions about your time horizon, your risk tolerance, and then they propose an overall asset allocation. And so I answered the questions, and they came up with this asset allocation, and they suggest 40% in bonds, 15% in small cap stocks, 15% foreign, 30% large cap stocks. So what they're saying is that they recommend I have 40. If I had a $100,000 account, they're suggesting that I should have $40,000 in bonds and $60,000 in somewhat riskier investments. So I could, if I think that's appropriate, I could decide to use a portion of that $60K for active trading, or all of it. That's really a personal decision, but this gives you at least a place to start. Based on my earlier analysis about the advantages of your doing more active trading inside an IRA, I could decide that, that if I'm looking at my whole financial picture, I could decide that, I think 40% bonds is good. That feels right to me. But I'm going to put that I'm going to do that in my brokerage account, my non-deferred brokerage account, where it's going to have less growth and less tax implications. And I'm going to go do my more active trading in my IRA, where I'm not going to be taxed on the gross gains. I'm only going to be taxed on the net gains, and only when I take a distribution. So that's, that's my thinking. I'm not an investment advisor. Don't know your situation. So this is for education purposes, and you can do with it what you like. But I hope you found that useful and interesting. As I put it together, I'm kind of a numbers geek. I thought it was interesting. So last topic, I'm going to send out some additional educational material if you are interested in it. I'm going to send out an email. I'll have a link. You can download this presentation. I'll also include a link to money management, risk management, another presentation that I did. That is just key. I think that's more important than your stock trading strategy. You got to have a risk management strategy first. I got a webinar that is recorded on my secrets to picking winning trades, and then I'll give you a link to sign up for my free weekly market analysis newsletter, which is called Beyond the Noise. And I offer, for your webinar attendees, I offer a special discount for my stock pick subscription service. So I'll have a link in there. There's like a 23% discount for that. And on my stock picking service, again, I'm at 26% year to date. Last year I tripled the indexes. Year before that I doubled them, and this year I'm quite a bit ahead. And again, my emphasis is on risk management. And so if my subscribers follow me, are experiencing those same returns if they're following me, the trades that I'm publishing. And with the subscription, you get 1 to 2 picks per week. You get midweek updates, option contract recommendations, cues on when to move your stop, when to scale out, with you there the whole trade. So that wraps it up. Again, I'll send out an email to everybody who signed up for the webinar, and I thank you for attending. I hope you found it useful, and always use risk control and trade to win. Thanks a lot.